Good day, everybody. We had a very interesting session after the inflation report yesterday. The dollar took it on the chin, and what a great guest to talk to about what's happening with the dollar, what's happening with the Fed, and yields. And Luke Gromen is here from the forest, from the trees. And Luke, appreciate you taking time out of this day. I'm sure that you were looking at what was happening in the dollar. I guess we could start there. And
Absolutely.
you've been looking for this for a while. I mean, this whole rally, people are declaring that this could be the beginning of a massive bear market in the dollar. I know you're not a market timer, but what are the implications here, Luke, if and you have a lot more company. You were saying this before, and now there's a lot of people talking about a potential big dollar slide this year. What are the implications if this is the beginning of a bear trend and we're going towards the sub 90 level in the dollar? How does that play out in markets, in your view?
Sure. I think ultimately, to start at the end, I think if the weaker the dollar gets, the more leeway the Fed has to both tighten and taper without blowing up markets, without blowing up global economies. I think
What a great
ultimately,
point. That's what I mean. I didn't even think about that, Luke. So, I mean, so actually, a weaker dollar could be the Fed's friend and ally for continuing to taper and tighten. They have another reason to do so to support the dollar, then, right?
I think that's right. And I think also when as we moved through late last year and we saw this dollar rally, it made sense to me what was happening in terms of that dollar rally. I didn't think that the Fed should be getting more hawkish. I thought that that was a mistake, but I thought that basically the dollar rising was communicating a Fed policy mistake of they shouldn't be tightening yet because there's still too much debt. They need to let inflation run hot to work debt down as a percent of GDP for an extended period of time before they tried to normalize. So that made sense to me. And as we came into this year over the last really few weeks, last couple weeks, really watching the dollar weaken as U.S. real rates strengthened in a very pronounced manner surprised me.
Yeah.
And I saw it had an epiphany in the last week that it hit me. We've seen at the same time as we've seen rising real rates and we've seen weakening dollar. We've also seen a pretty pronounced sector rotation, particularly over the last 2 months, out of tech into
Yes.
commodities, industrials, cyclicals, which makes sense from a cyclical standpoint. And I think
And financials too, right?
and financials as well, right?
Yeah.
Sort of the classic
Okay.
recovery playbook. And I had this epiphany in the last week or so that if you go back to May of last year, arguably one of the most legendary FX traders, Stan Druckenmiller, was on CNBC, and he gave an interview in which he pointed out that the U.S. is still running big deficits, that foreigners were no longer buying nearly enough treasuries anymore. They weren't sterilizing those deficits in the treasury market anymore. Where they were sterilizing those deficits were in U.S. tech stocks. So the U.S. was running deficits, and those deficits were being recycled back into U.S. tech stocks. And he made this point. It maybe was 5 seconds in total in the interview, but he makes the point that if you start to get a sector rotation out of tech into cyclicals, industrials, commodities, which are sectors that in which the United States is not as well represented as a percent of the indices. It's where you would generally see capital flow out of the U.S. into emerging markets, et cetera, in that sector rotation. Then suddenly the deficits that aren't being recycled or sterilized into treasuries would start to also not be recycled or sterilized into tech. And you would
Yeah.
start to see capital outflows out of the dollar, and the dollar would weaken. And when I had this epiphany that, oh my gosh, I think that might be what we're starting to watch happen, which is myself and I think a lot of other traders have been watching real rates and the dollar and sort of what the dollar's been trading on over the last several years, more than not. And I think we might be starting to see the very early days of a regime change where the dollar is paying more attention to capital flows at the moment. Basically, this sector rotation is dollar negative in the presence of ongoing U.S. deficits. And so it's very early in this process. I don't want to get carried away with it, but I think that might be what we're starting to see.
Well, it should be interesting. I have QQQ up here, and the dollar outflows. I believe I've talked to you about it too, Luke. Have you seen the commercials where some actor jumps into a football scene or a scientific experiment, and they don't belong there, and they go, "Who are you?" And they go, "Oh, well, I invest in QQQ." So I mean, that QQQ commercial was kind of like being on the cover of Barron's or Time magazine. And I've heard that argument that people were parking, even crypto people thought that the FANG stocks were a safe haven. I actually heard that last year. Honest,
Yeah,
I can't make that up.
no, that's I saw that, and it makes sense as long as there's never sort of a cyclical recovery. And that is something, even like I said, it's, and I don't want to throw glass houses because I'm here, or throw stones because I'm living in a glass house myself, as I had forgotten about that capital flow aspect
Yeah.
of the dollar. And if you get, it's been a long time since we've had early stage cyclical recovery type of move. I mean, this is almost reminiscent a little bit potentially of that 2002 2003 timeframe, right, when we came off
Okay.
of the last big tech bubble,
Right.
and the stock market was flat to down, but there was underneath this vicious sector rotation where industrials and commodities had their day in the sun for. I mean, really, it was interrupted by the 0809 timeframe, of course, but you had a 2003 to 2011. It was an 8-year bull run in commodities and a bear run in the dollar, as you had sort of that sector rotation, aided, of course, by China at that time really ramping up.
Yeah. So I mean, there were different commodity markets that didn't even need a strong dollar to perform. Here you go. Soybeans. So soybeans,
You mean a
they've
weak
had
dollar?
higher
Yeah,
highs.
yeah.
Anything that grows, Luke. I mean, I saw you pose a question, which would be a better headline for the midterms, 6% inflation or a recession? How can higher rates create a bear market in food?
You know, it's
The cutting,
it.
make people, I mean, are higher rates going to put you on a diet?
No, and
It's,
it's exactly right, and it's one of these things that makes the present environment so tricky for the policymakers, because there's a number of different things happening in commodities that are very structural in the way that you
right,
alluded to, which is China has water problems. If China has water problems, that's the biggest bull case for ag commodities out there, because the easiest way to import water is to import ag commodities. It's just embedded water, right? So if China's got water problems, that's a really positive tailwind for commodities. It doesn't matter what economic growth is doing. It doesn't matter what rates are. To your
right.
point,
Yeah, and they decided not to ship fertilizer to the U.S. Farmers are up in arms at the prices for fertilizer and how they're going to bring in a crop. So, that's also part of this inflation process, isn't it, Luke? We went from just in time inventory systems to out of time, out of product, and now out of favor with what used to be reliable suppliers.
I think that's right, and I think it also again ties back to this some of these structural issues that the inflation debate is ignoring still, by and large. And by that I mean not just the Chinese water issues we talked about, which when you translate them work out to global food price
Yeah,
support, but peak cheap energy, peak cheap metals are also, you've had extended periods of underinvestment. The ore grades or the resource bases are to increase production substantially across a wide swath of commodities is going to require substantially higher prices, and or else there'll be shortages. And that's when you talk about energy, you're talking about the master resource, right? And that's part of the
right.
reason why we're seeing these fertilizer problems in parts of the world, is when natural gas spikes up to absurd levels in Europe and other parts of the world. You've seen there have been plants across the world, fertilizer plants across the world, that have shut down because they either can't get sufficient gas, or the gas is so expensive it's uneconomic. So it's
How does monetary policy address this? It seems like that it will mainly be just, in the real world, even taking rates at 2% aren't going to address the things that you and I just talked about. All they could do is, if they want to, they're not going to do what Volcker did. The financial markets couldn't stand that. What do you think the threshold is for yields, Luke? Because I know you think that eventually we're going to go to, everyone thinks the rates are low now, even though they're heading up, to even lower yields. And there are historical precedents of when we've had negative interest rates at much lower levels than we were at on the real yield.
Absolutely. I think ultimately at the end game, real yields have to go significantly lower for an extended period of time to get sovereign debt levels, and particularly those in the reserve currency issuer US, down to a level from which the Fed can normalize policy. Now, I found that when we talk about, or when people talk about where do rates start to become a problem, I think it's important that we don't focus on one single metric. I find a lot of analysts that are doing that. What I mean by that is, with the DXY at 96, I would argue we were getting to levels of rates that were already problematic. And I think that's what we were seeing with the more sensitive liquidity metrics, whether that's the Turkish lira or Bitcoin. And then we started to see in equity markets over the last 2-3 weeks. Now, if we wake up in 6 months and the DXY is at 80 or 82, the level of interest rates that are problematic are likely a bit higher. It gives the Fed a little bit more leeway to do that. And so there's a couple different levers that they have, but I think it really centers around the dollar, given the global dollar debt dynamics, the euro dollar system dynamics, where if they can get the dollar down to create breathing room, to create underlying economic growth in rest of world, then the Fed can do some things. They can let rates rise a bit longer. But ultimately, when you talk about if they get the dollar down enough, what we're really talking about is if they get real rates low enough, right? Because as the dollar weakens, we're going to see inflation continue to run higher. And so the Fed will be raising rates, but it might be a situation like the 70s where rates rose, but real rates fell. And I think that's really, given the debt level, the only playbook that they have is they've got to get an extended period of increasingly negative real rates.
Well, I look at this as a technician, and it looks pretty ominous to me, this TLT weekly chart, Luke, and I've been showing it for a while that, this was the when the Fed came in COVID, and we retested the lows, and this bounce so far has been pretty weak. So with a weaker dollar, and you're already saying that foreigners aren't coming into our treasury market, are they avoiding it because who wants paper denominated in what may be rapidly depreciating currency from here? Is that going to also create less demand?
Well, it's a paradox, really. I think there's not enough demand because the dollar is too strong. There is some geopolitical dynamics. There's, basically, it actually works in opposite of how you think. In other words, the weaker the dollar gets, if you look at the data, the stronger, excuse me, the stronger foreign and international buying of treasuries has historically been. So here too, it's interesting. We find that now, up to a point, that's not true ad infinitum, right? If inflation was absolutely going crazy, you would expect that there would be concerns about the dollar getting too weak. But there's a happy medium, and that happy medium is here too. I think the weaker dollar is the Fed's ally for a time, because as the dollar weakens, you'll see foreign and international buying of treasury paper pick up, as is typically the case. They run bigger surpluses. As the dollar weakens, they have more economic breathing room. A stronger dollar hurts them. A weaker dollar frees space for their economies to oversimplify. And then they also do buying of treasuries to manage the rate at which their currency appreciates against the dollar. And so there's this counter-cyclical balancing that if the dollar weakens, the Fed will have more leeway to tighten. The Fed will have more, the rates will have more leeway to rise without blowing things up. And there should be more foreign and international demand for treasuries as the dollar weakens within reason, which also helps the Fed because, of course, the Fed's saying they're going to taper QE, which means that they're selling treasuries. They need a buyer. And so, when you sort of solve for Fed wants to hike, Fed wants to sell treasuries, a weaker dollar checks both of those boxes.
It helps the central planners, Luke. Doesn't help John Q. Public, who's already under pressure with higher prices. A weaker dollar cannot be advantageous to people who are paid in a depreciating currency when there's already inflation issues. Don't you agree?
I agree, and it's one of these sensitive political issues where part of the reason why the Fed has as little breathing room as they do is because the prior politicians over the last 50 years have made bad decisions or, penny wise, pound foolish decisions, shall we say, on behalf of John Q. Public, right? So it's, FDR and LBJ promised retirement benefits in the form of entitlements and pretty much figured that they would be dead before they would come due. But sure enough, 70 million baby boomers were born. It stood to reason they were going to turn 65 someday. And here we are. So it's one of these, tough issues that is inflation stinks for John Q. Public. But part of the reason they need to inflate the debt away is because of John Q. Public's entitlements.
Entitlements. Yeah. So what's the end game here, John? I mean, really, when we look at what's going on here, Luke, it's hard to know whether or not you still stay in a risk-off environment during inflationary times, or risk-off is only in the dollar selling and treasuries. I know that you believe in metals, and silver actually put in a pretty nice stay. Do you think that everyone should own some of this?
Yeah, I think you want to own some silver and gold. I think the end game when you talk about it is it's an interesting inflation versus the 70s in particular, because U.S. debt to GDP, we'd already inflated away, debt for 30 years by 1975. And so U.S. debt to GDP was down to 30%, and it's 125, 122% today. And the importance of that is in the 70s, you had the leeway to allow interest rates to be the release valve, and the difference now is with debt to GDP this high, you can only allow interest rates to be the release valve for so far, and once it gets to a certain level, then people are going to start to be concerned about, okay, they're going to have to do some form of hard yield curve control, or basically a situation where the higher yields go, the more incentive there's going to be for the balance sheet of the Fed and other central banks around the world to grow faster, not slower, because the levels of debt simply don't give them the same policy options that they had in the 70s. And so I think when we translate that into markets, I think it's really good for gold and silver and commodities over time, but I think it's going to be nominally good for a lot of for the stock markets, indices, broadly speaking, as well, as people,
Yeah, dollar depreciates 20%, market's up another 20%.
Right.
There is this geo issue that's really bubbling on the stove with Russia and Ukraine and all the troops amassed there. Do you believe Putin's going in? And what do you think the reaction in the markets will be? A lot of people don't seem too concerned about it. I asked people, well, what happened to the markets when he went in the first time and annexed Crimea? And I can't remember, and most people can't. So it probably wasn't real major. Could it be now, though, with everything else that's going on?
The short answer, I think, is it could be, I think, especially for commodity markets around what's happening in Kazakhstan. Ukraine, I would be surprised if he went in. I think
Really?
I don't know what he gains by doing that. And I think he just wants to keep some border security. And so I would be surprised if he did. I don't think it'll be a big deal, even if he did. I think the bigger thing that I've been kind of keeping, one eye on, or half an eye on, if you will, has been the situation in Kazakhstan, because that is the world's biggest uranium producer. They are a substantial oil producer. And so if there is some problem with exports of uranium or oil out of Kazakhstan as a result of what's going on there, that could start to, that could have real implications in energy markets pretty quickly. And then I think, we're already very, as we were talking about before, pretty precipitously balanced in some of these commodities. We don't have the ability to take supply offline without there being a pretty pronounced price response.
Yeah, so I think you coined those terms: peak, peak max energy, and
peak cheap energy. Yep.
Yeah, and peak supply of minerals, and you bring up uranium. And wasn't it Kazakhstan that has already asked for aid from Russia, from other former satellite countries? So I've heard that Russia will continue to be involved in there. They don't want another Syria.
They don't want another Syria. Yeah, I think they don't want another Syria. And there have been some interesting articles in the last week or so, in both the U.S., excuse me, and the West and the Eastern press, that Russia does not want. They've had it with these color revolutions, what are called color revolutions, like we saw in Ukraine. And excuse me, let me get a quick glass of water. I apologize. I think they are. Putin communicated that they were done seeing these things, and so the head of Kazakhstan asked for Russia's help. Russia sent special forces in, retook the airport at Almaty very quickly, and so I think they are. I think there's a communication there that this type of sort of soft power, war will not be tolerated the way it was a lot of other times in various other parts around the world,
like Georgia too, as well. So when they go in, they usually don't leave. I mean, they left Afghanistan, but they usually don't leave, just like every other major empire. So looking at Kazakhstan and the Fed and the breakdown in the dollar, we have to change our minds about how we've been investing, especially, Luke, if this is a major turn in the dollar, it's going to have wide-ranging implications for everything, because we haven't been here. You almost have to be an older guy to remember the 70s. And I actually heard that inflation, when Nixon imposed price controls, it was only half as bad as it is now.
Oh, wow. I didn't realize that.
Yeah. So, win buttons, whip inflation now.
Yep.
So do you think that Biden would try something like price controls, or the administration try something that was tried in the 70s? They don't work, but will they attempt it?
I think if it gets to energy markets, you'll see something. In other words, if we see gasoline start hitting $4 and $5 nationwide, maybe this summer, and I don't know that that'll happen, but I think it's a possibility. I think if you see very sensitive markets like that, politically sensitive markets so close to the midterms, I wouldn't be surprised if the Biden administration came out and reimposed oil export bans. And again, I don't know that it'll do a lot, because there are grade issues in terms of what we import and what refineries can handle in various parts of the country. But he would need to be seen doing something. And that's where I think it would be an issue. I mean, you're seeing clearly, pressure on grocery stores to stop price gouging, meat companies to stop gouging. So there's not explicit price controls.
There's more pressure with empty shelves right now, Luke. I mean, I'm seeing it all over the country, and a lot of it's a supply chain issue. But it's scary when you see groceries, people shopping and going to look for food for their families, and they have to go 3-4 stores and they can't find it. I mean, I think that we've gotten used to a lifestyle that maybe we're a spoiled generation, and that maybe tougher times like our grandparents went through might be upon us, with shortages of groceries.
Yeah, and I think when I've seen some of the shelf pictures, and I've seen some certainly in my own neighborhood. I always want to be careful of, are these pictures from a place where we just had a massive snowstorm, right? So the
Yeah,
Washington
right.
area, so I
Yeah.
think there's some of
Okay.
that and some drama. So I'm hoping that's the case.
Yeah, me too, buddy.
But it's, it is one of these things where we're seeing these supply chains, as we have come to appreciate them, stretching 3,000 miles back to China. I think those days are ending, and the challenge is so much has been offshored that as we bring them closer to home, I think that's the right thing to do in the intermediate and in the long run. But in the short run, that's going to add to the inflationary pressures more. I mean, it's not cheap to bring supply chains back. It was disinflationary to move all that stuff to China. It strains
Yeah.
credulity to think it'll be disinflationary when we bring it back.
And it's going to take so much time, isn't it? It's
It
not
will.
going to, it's going to take years.
It will. It will.
The Chinese have the patience for 10-year plans and 100-year plans. And in America, it's more like, what did you do last month or last week or yesterday? So
It really
Luke,
is.
I pulled up your website. I want people to know what a valuable resource you could be on the big picture, because what a great name for your company, because you don't know how many trees I've tried to chop down. And where if I had just seen the forest, I would have found a better tree to take my axe to, and really appreciate your work and your insights, the way you react to the new narratives that are here. And I think this is your time, and it's going to be really interesting to see how much 10-year yields could rise before we reach a kind of red line. I'm thinking not much more above 2%.
I don't disagree, and it's with the caveat, like we said before, that if the DXY is at 85, we might have more leeway. But with the DXY here, I agree. I don't think it's a lot above 2%.
Okay, and then we could be on our way back down towards negative rates in the next few years, when perhaps this is a Fed policy error and they tighten too much and we have a bust. Is that on the back burner? Could that happen? I mean, it was a policy mistake to think inflation was transient. Is this another one, which you call the Fed isn't using a dial now, they're using a switch? So they flipped the switch. Are they going to have to flip the switch again if the market can't handle 2, 3, 4% rates?
Yeah, I think it's, they flip the switch from, it's not a dial, it's USA or global economy on to global economy off in terms of what they want to do with QE
Okay.
taper and rate hikes. But over here they have the backup generator, which is DXY, right? So they're pulling on the string of that thing, trying to
Yeah.
get that bad boy going in the right direction, right? To start up that backup generator. And if that backup generator catches and goes, if you will, and the dollar goes down, then that probably gets them into at least a glide path, rather than simply, shutting off the engines and hoping for the best.
Okay, well, you brought up crypto, so I'm wondering what you think about one of Brainerd's thesis is and policies is that she's very much in favor of a digital coin for the U.S. What do you think? Is this the future for the U.S.? I mean, there's been a war on cash forever. Is this how they end up winning the game, eliminating all privacy through a digital coin?
Yeah, and that was going to be my point. Is I think it's a terrible idea. I think because then the central bank can
Do everything.
they can do everything. They can cut out the banks. So I don't know that the banks are going to love that. I mean, I don't know that it's bad for the banks, because I think the banks will continue to just LBO themselves. And they could be good stocks, even though they'll be boring businesses at best if we have a central bank digital currency. But I think it has very broad ranging and frightening privacy implications. And it's also another one of these paradoxical situations where the Fed will win. In theory, they will finally be able to have complete control, but the win will actually be a loss, because they will then be completely married to the fiscal side. And you'll, as Lacey Hunt says, if the Fed starts giving legal tender directly to spenders, that's how you get hyperinflation. And so the Fed would have complete control, and they would probably be in the express lane to hyperinflation, which it's a win, but it's a loss. So I think it's a really bad idea. but there are, certainly the more liberal leaning parts of the Fed establishment, like Brainerd, they see the value in it. So I think it's something that needs to not happen, but
Yeah. Okay.
we'll have to watch and see.
Yeah, definitely. And I'm really appreciate your view on it, because we've been hearing about the war on cash, and, we're pretty digital now, but that would probably end it. And maybe she doesn't get confirmed.
Yeah, it's it's
Anyway,
possible. Anything's possible, right?
yeah, hope is good in life, not in the markets, but in life. And I hope we could do this again, Luke.
Absolutely.
I really enjoyed talking to you. I know I could ask you anything, and you've thought about it before I have. So really appreciate your insights and wisdom, and encourage people to go to your website, FFTT-LLC.com, for Luke's work. And thank you so much. I hope 2022, Luke, is a great year, and that all the people that listen to your words and read your work are able to see the forest from the trees with you as their guide.
Thank you very much. Thanks for having me on, Dale. It was great catching up again, and I hope you have a great 2022 as well.
Thank you, buddy.
All right,
good hunting, everyone. I hope you enjoyed it. Luke Gromen, and we'll